Hey everyone, Asama Herakli here. Welcome to this deep dive explainer on Study Unit 8 from the CIA exam syllabus. Today, we are focusing entirely on controls and their specific types. If you're studying up to master governance, risk management, and internal controls, you are absolutely in the right place. Let's get right into it.
So here's our roadmap for today's session. We'll start with a broad overview of control, move into automated processing, outline the roles of internal auditors, and then unpack the specific types of controls, right down to IT general and application controls.
All right, kicking things off with Section 8.1, Overview of Control.
Now, you're going to see a ton of questions on the CIA exam about controls. But here's the thing, very few of them can be answered just by memorizing flashcards. You've got to be able to synthesize these concepts and apply them to totally unfamiliar scenarios. So to do that, we first need to define an interconnected trio: control, control processes, and the control environment. Control is essentially any action taken by management and the board to manage risk and hit those organizational goals. Control processes, those are the actual day-to-day policies and activities designed to keep those risks within the organization's tolerance level. But the real foundation here is the control environment. This is the attitude, the discipline, the overall structure provided by the board and management. We're talking about integrity, organizational structure, human resource policies, the whole shebang. Together, these form a cohesive framework that gives your organization the actual capacity to navigate uncertainty.
But we have to be realistic here. Even the absolute best governance and control processes can only ever provide reasonable assurance, never absolute assurance. Why is that? Well, it's because of inherent limitations. First off, human judgment is faulty. People get tired, mistakes happen. Second, management might inappropriately override controls to hide liabilities or boost numbers. Third, controls can be completely bypassed if employees decide to collude together. And finally, you have the cost-benefit limitation. The cost of implementing an internal control must literally never exceed the benefit it provides. It just doesn't make business sense.
Moving right along to our next section, characteristics of automated processing. Look, the shift from manual to computer-based systems is a huge game changer. It fundamentally alters the business transacted, the procedures followed, and the methods we have to use to mitigate new risks. Let's look at three main characteristics. First up, audit trails. In a computer system, a complete audit trail might only exist for a split second, or it's purely in a computer-readable form. Second, uniform processing. Now, computers are great because they eliminate simple clerical errors by treating similar transactions exactly the same way. But if there is a programming error, every single similar transaction is going to be processed incorrectly. It amplifies the mistake. Finally, segregation of duties. Let's think about example 8.1 from our text. It used to be that receiving cash, writing a receipt, and making a journal entry were handled by 3 different people. Today, a computer might generate all of that automatically based on one input. If the same employee receives the cash and enters the data, your fraud risk absolutely spikes. So, new compensating controls are a must.
We see this shift beautifully in example 8-2, looking at an electronic data interchange or EDI system. In an EDI setup, a company's computer might automatically fire off a purchase order to a vendor the second inventory drops below a certain level. Zero human intervention. Now, decreased human involvement actually reduces the potential for observation-based fraud, which is great. But on the flip side, errors in the application's design can sit there undetected for a very long time. It's not all bad news, though. Computer systems give management incredible analytical tools. You get highly efficient, timely supervision and statistical review that a manual system could never dream of.
So with all that in mind, how do you actually choose your approach? Well, manual controls are your go-to when judgment and discretion are required. Think about large, unusual, non-recurring transactions, or when you actually need to monitor how well the automated controls are working. Automated controls, however, hit the nail on the head for high-volume transactions that need complex calculations or where you're dealing with circumstances demanding a very strict, high degree of accuracy.
Let's transition over to Section 3, Roles of Internal Auditors.
Controls mitigate risks at the entity, activity, and transaction levels. And honestly, everyone has a part to play. Senior management oversees setting them up. Managers assess them within their own departments. But for internal auditors, our role is to provide independent, objective assurance. We follow a very specific process. Step 1, evaluating effectiveness relative to cost. We often use a risk and control matrix for this to identify risks, determine their significance, and test the control design. Step 2, evaluating efficiency. We're essentially asking,
Do the resources we are pouring into this exceed the benefits we're getting out? And step 3, promoting continuous improvement. This isn't just a buzzword, it requires tangible actions. We're talking training, self-monitoring, assessment meetings with managers, identifying weaknesses, and constantly updating the team on new technical developments.
All right, diving into Section 8.2, Types of Controls. We can break controls down into primary and secondary categories. Let's start with primary. You have preventive controls, which deter problems before they even happen, like a lockbox. Then there are detective controls, which alert you after something unwanted happens, like a burglar alarm or a system rejecting a duplicate invoice. Corrective controls come in to fix the negative effects, such as requiring justifications for budget variances, and directive controls encourage desirable events, like having a solid training manual. Now, what about secondary controls? These supplement your primary ones. Compensating or mitigative controls are what you use when proper segregation of duties is missing. Think back to example 8.4 in the text, a cash sale environment where a single clerk authorizes the sale, records it, and holds the cash. Huge risk, right? The compensating controls there would be the cash register's unerasable record, security cameras, and employee bonding. We also have complementary controls, which simply work synergistically with other controls to reduce your risk to an acceptable level.
Next up, you really have to understand the 2 basic processing modes. First is batch processing. This is where the system accumulates transactions and submits them all at once as a single batch. It is incredibly efficient for high-volume routine tasks like payroll. A key feature to remember here is memo posting, which banks use to post temporary transactions to your account until the actual end-of-day batch runs. On the other hand, we have online real-time processing, or OLTP. This updates the database instantly upon entry. An airline reservation system is the classic example. If you don't have the latest information available instantly, you're going to overbook flights. It's also helpful to think of controls as being arranged in a hierarchy. At the very top, you have entity-level controls addressing organization-wide risks. These include the big governance controls set by the board of directors, like a corporate code of conduct, as well as management oversight at the business unit level, like a supervisor approving overtime. Below that, we have process-level controls addressing specific process risks. Think physical inventory counts. And finally, transaction-level controls get right down into the weeds, addressing specific transactional risks using things like exception reports.
Moving on to Section 5, IT General Controls.
Before you even think about securing specific applications, you have to secure the overarching IT environment. There are 4 major IT general controls you absolutely must know. First, logical access controls. These limit system access via authentication and authorization, basically requiring strong passwords. Second, systems development lifecycle, or SDLC, and program change management controls. These ensure that any software changes or vendor updates happen under very close supervision. Third, physical security controls. This is literally protecting the physical servers and data centers from unauthorized access, fires, or floods. And fourth, system and data backup and recovery controls. If a disaster strikes, you need a way to ensure your data and business processes can be restored immediately. And that brings us to Section 6, Application Controls. Unlike those general controls, application controls are built directly into specific software, like your accounts payable system, to ensure data is accurate, authorized, and complete. Now, the cheapest and most economical time to catch an error is right at the input stage. For batch input, we rely on financial totals and record counts. We also use hash totals. Remember example 8.5? Say we have 4 invoices numbered 303, 305, 353, and 359. The hash total is just adding those meaningless invoice numbers together to get 1320. If the computer calculates 1320 after processing, you know for sure that all records were processed. Now, for online real-time input, our controls look a bit different. We use pre-formatting screens so they look like familiar paper forms. We use field checks so that automatically reject letters if someone types them into a social security number field. We use limit checks so an employee can't accidentally log 150 hours in a single week. And we use check digits, which are clever little algorithms used to verify identification codes. But the job isn't done at input. We also have processing, output, and integrity controls. Processing controls ensure data accuracy during the actual updates. A huge one here is concurrency controls. Concurrency manages simultaneous access. It's literally what prevents 4 different customers from successfully buying the exact same flight seat at the exact same time. Output controls ensure proper distribution of data and heavily rely on manual user review. Finally, integrity controls monitor data alignment and formula accuracy in storage.
For example, rejecting a spreadsheet calculation that somehow results in text instead of a number. You know, controls don't just exist in the present moment. They actually operate across time. Feedback controls report on completed activities, letting you improve by learning from past mistakes, like inspecting completed goods as they come off the line to check for variances. Concurrent controls adjust ongoing processes in real time to prevent deviation, like a manager closely supervising workers on an active production line. And feed-forward controls, they anticipate and prevent problems with a long-term perspective. Establishing strict organizational policies is a great example of a feed-forward control.
Let's juxtapose a few more concepts to really lock this in. Financial controls are based on accounting principles. They are focused entirely on authorization, record-keeping, and safeguarding assets. Operating controls, however, apply to production and support activities and are based on management methods like quality control or cost reduction programs. We can also contrast people-based controls, like an accountant diligently running through a month-end checklist, with system-based.
Okay, let's tie all of this theory together using a control matrix. Let's walk through this petty cash example from figure 8-2. A key takeaway here is that controls almost never match risks on a neat one-to-one basis. If your risks are an empty petty cash fund, unsecured cash, and unsupported disbursements, you're going to need multiple controls. Control A establishes a maximum balance. Control B requires storing cash in a locked safe. Control C and D require specific disbursement receipts and approvals. Notice how a single risk, like the fund not being maintained at its established level, maps to multiple controls across the top axis. This matrix mapping is exactly what auditors use to evaluate if a control design is actually adequate.
Just as a rapid review before we finish up, let's firmly anchor the difference between these IT control categories. General controls apply broadly to all systems, things like segregation of duties, physical access, and environmental controls. Application controls, on the other hand, are embedded directly into your specific business processes, covering the exact input, processing, and output validation for that specific software.
And that wraps up our masterclass on controls. I want to leave you with a challenge. How will you apply continuous improvement to your organization's control environment today? Don't just memorize this stuff. Take this theory, identify a real risk in your own processes, and design a control to mitigate it. Until next time, stay energized and keep applying these principles.